What if I told you that SoFi Technologies, one of the most disruptive names in Fintech, is quietly positioning itself to not only survive a tough economic climate, but potentially dominate the next phase of digital finance? In this deep dive, we'll go beyond the headlines, break down SoFi's latest earnings report, and uncover the trends, challenges, and opportunities that every serious investor needs to know before making their next move. SoFi started with a simple mission: helping students refinance their loans at better rates, but it has evolved into a full-scale financial services powerhouse. Today it offers personal loans, mortgage refinancing, credit cards, cryptocurrency trading, robo-advisory investment services, insurance, and even banking products through its national bank charter. This diversification isn't just for show. It's part of a strategy to become a one-stop shop for digitally native customers who want all their financial needs handled in one sleek app. The fintech sector has been growing rapidly, but it's also facing unprecedented challenges. Rising interest rates have reshaped the lending market, inflation has pressured consumer spending, and competition has intensified as both big banks and nimble startups fight for market share. SoFi's earnings report provides a real-world stress test of how well it's navigating these pressures. When we zoom into the numbers, one thing stands out: growth is still strong. SoFi's total revenue has been climbing steadily, with recent quarters showing double-digit percentage increases. A major driver remains its lending segment, particularly student loan refinancing, which has seen renewed demand after the end of the federal student loan payment pause. Personal loans have also been in high demand, reflecting consumers' need for credit in a higher-rate environment. But lending is no longer SoFi's only growth engine. Its technology platform segment, powered by the acquisition of Galileo and Technesis, provides payment processing, banking infrastructure, and fintech service solutions to other financial companies. This is a highly scalable business that generates recurring revenue and strengthens SoFi's role in the broader financial ecosystem. Meanwhile, its financial services segment, which includes SoFi Invest, SoFi Money, and SoFi Credit Card, has been steadily growing users and deposits, adding cross-selling opportunities that increase customer lifetime value. Of course, expansion comes with costs. SoFi's operating expenses are still high, driven by aggressive marketing, technology upgrades, and compliance investments. The good news? Adjusted EBITDA has been improving quarter after quarter, and net losses are narrowing. This signals that SoFi's heavy investments are starting to yield efficiency gains, a crucial step toward long-term profitability. From a strategic perspective, SoFi's decision to secure a national bank charter in early 2022 is proving to be a game-changer. It allows the company to hold customer deposits directly, reducing its cost of capital and giving it more control over lending operations. In today's rate environment, this means SoFi can be more competitive on loan pricing, while still protecting its margins. A key advantage over non-bank fintechs that must rely on more expensive funding sources. Regulation remains a potential headwind as governments around the world tighten oversight on digital finance. SoFi has proactively built a compliance infrastructure to handle these requirements, which could ultimately be a competitive advantage if smaller rivals struggle to keep up. The customer metrics tell another encouraging story. SoFi has consistently reported strong growth in members, with millions of new accounts being added in recent quarters. Average product per member is also increasing, meaning customers are using more of SoFi's services over time. This deepens engagement and reduces churn, both essential for sustainable revenue. From a balance sheet perspective, SoFi remains in a solid position. It has substantial cash reserves, diversified funding sources, and a manageable debt profile. Liquidity levels are healthy, ensuring it can meet obligations while continuing to invest in innovation. Looking ahead, SoFi's management is guiding for continued revenue acceleration driven by lending growth, tech platform adoption, and expansion in financial services. If profitability arrives as projected in the next few quarters, the market's perception of SoFi could shift dramatically. This could attract more institutional investors and potentially lead to a re-rating of the stock's valuation multiples. In short, SoFi is no longer just a scrappy disruptor. It's evolving into a diversified, tech-driven financial institution with the infrastructure to compete head-to-head with banks and the agility to out-innovate them. Its latest earnings suggest it's on the right path, but the road ahead will still require careful execution. So, is SoFi a stock to buy now, or one to simply keep on your watch list? The answer will depend on your investment horizon and risk tolerance. But one thing's for sure, its earnings report offers valuable insights into the future of fintech, and ignoring those insights could mean missing a major opportunity. What's your take on SoFi's future? Drop your thoughts in the comments, and if you want more deep dives into market trends and stock analysis, make sure to subscribe and check out my other videos for the latest insights.